Here's something nobody tells you about the two most talked about businessmen in America. Elon Musk didn't get to a 12-figure net worth because of rockets. And Donald Trump didn't build his fortune through Trump Tower alone. The real money, for both of them, has quietly moved into things that sound almost embarrassingly dull. Payment processing, real estate holding companies, infrastructure permits, boring government contracts nobody tweets about. And that's not an accident. It might be the smartest financial habit either of them has. Stick around, because by the end of this video, you're going to look at boring businesses completely differently. And you might just find one hiding in your own city. Let's set the stage. When most people picture how billionaires make their money, they picture the flashy stuff. Elon Musk, electric cars, reusable rockets, brain chips, an AI chatbot on a platform he bought for the price of a small country's GDP. Skyscrapers with his name on them. Golf resorts, reality TV, a media company built on a stock ticker. That's the story the headlines sell. It's exciting, it's clickable. It's the version of wealth that fits in a 15-second clip. But here's the thing. Analysts, biographers, and financial journalists have pointed out for years. The flashy stuff is often the marketing. The quieter, less photogenic parts of these empires, the licensing deals, the real estate holding structures, the infrastructure and permitting businesses, the unglamorous B2B contracts, are frequently where a huge chunk of durable value actually sits. This isn't a conspiracy theory about two men secretly running the country from a spreadsheet. It's actually a much older, much simpler idea from the world of investing, one that shows up again and again whenever you study how sustained wealth gets built. Glamour attracts attention. Boredom builds balance sheets. In this video, we're going to break down what boring investing actually means in plain English, how this pattern shows up in Trump's business history, how this pattern shows up in Musk's business empire, the psychological and financial reasons boring businesses are so profitable, real-world, non-billionaire examples you can actually learn from, the other side of the argument, because it's not all one-directional genius, and finally, how you, watching this on your phone or laptop, can apply the exact same principle at a much smaller scale. Let's get into it. Before we point fingers at anyone, let's define our terms, because boring is doing a lot of work in this video's title. In investing circles, a boring business usually has some combination of these traits: predictable, recurring revenue. People pay for it every month, whether the economy is booming or not. Think waste management, utilities, insurance, toll roads, parking. High barriers to entry. It's hard for a scrappy startup to suddenly compete with you because you need permits, land, regulatory approval, or decades-old contracts. Low glamour, low public attention. Nobody's making a documentary about a regional water utility, which means less hype, less competition, and often cheaper valuations. Essential, not optional. People need electricity and garbage pickup even in a recession. They don't need a new gadget. Warren Buffett, arguably the most successful long-term investor in modern history, built Berkshire Hathaway on exactly this philosophy. His portfolio has never been about the sexiest tech IPO of the year. It's railroads, it's insurance, it's candy companies and paint companies and underwear companies. Genuinely boring stuff. And it's made him one of the richest people on Earth over a multi-decade horizon. A cutaway graphic. Buffett's Berkshire Hathaway Holdings, showing simple icons, railroad, insurance, paint can, candy. So when we talk about Trump or Musk gravitating toward boring businesses, we're really talking about them tapping into this same decades-old investing logic, whether they'd frame it that way themselves or not. The flashy ventures generate headlines and cultural relevance. The boring ventures generate cash flow that doesn't evaporate when public opinion shifts. Keep that distinction in mind because it's the spine of this whole video. Attention businesses versus cash flow businesses. Let's start with Donald Trump, because his business history is actually a textbook example of this pattern. Going back decades before politics entered the picture, the public image of Trump's business career is Trump Tower, Trump casinos, Trump airlines, the golf courses, the beauty pageants. Glamorous, name on the building stuff. But financial journalists and biographers who've dug into his actual filings have pointed out something interesting. Several of those headline ventures, the airline, some of the casinos, ran into serious financial trouble over the years, including well-documented bankruptcies of Trump-branded casino companies in Atlantic City in the 1990s and 2000s. Meanwhile, what kept generating steady value in the background was less exciting: commercial and residential real estate leasing, buildings where the money comes from long-term tenants paying rent, not from ticket sales or gambling revenue. Licensing deals, allowing other developers to slap the Trump name on buildings they built and owned, with Trump collecting fees without carrying the construction risk himself. Golf course and club membership models. Recurring membership dues are a classic boring revenue stream, closer in structure to a subscription business than to a flashy one-time sale. This is the pattern. The loud name-brand ventures got the press coverage. The quieter leasing, licensing, and membership fee structures did a lot of the actual financial heavy lifting because they didn't depend on constant reinvention or public excitement to keep the cash coming in. Think of it like this. Imagine your cousin opens a flashy new restaurant downtown. String lights, influencer nights, a line out the door, exciting. But imagine your other cousin owns the building the restaurant is in. Every month, rent shows up, whether the restaurant is trendy or not, whether food critics love it or the concept flops in 18 months. One cousin is playing a high-visibility, high-risk game. The other cousin is quietly collecting a check. Historically, a meaningful part of Trump's business model has resembled that second cousin far more than the tabloids suggest. More recently, this same logic has extended into new territory: holding companies, media ventures with licensing structures, and diversified financial vehicles that generate fees and equity value somewhat independent of day-to-day media attention. We're not going to make specific claims here about currently ongoing ventures, because that's genuinely contested territory with strong opinions on multiple sides. But the underlying pattern, historically, is well documented: flashy ventures for the headlines, structural ownership plays for the balance sheet. Now let's flick to Elon Musk, because at first glance this seems like the opposite story. Isn't Musk the definition of flashy? Rockets, humanoid robots, neural implants, a car company that live streams product launches like a rock concert. Yes, and that's exactly the point. The flash is the marketing layer. Underneath it is a surprisingly boring, methodical financial structure. Let's look at a few examples. Tesla's actual profit engine. For years, a significant portion of Tesla's reported profitability came not from selling cars, but from something almost nobody talks about at parties: regulatory credits. Under emissions regulations in the US and elsewhere, traditional automakers that don't sell enough electric vehicles have to buy carbon or zero emission credits from companies that do, companies like Tesla. Selling these credits to other car manufacturers has, in multiple reported quarters, contributed meaningfully to Tesla's bottom line. That's about as unglamorous as business gets. It's essentially a government-created compliance market, and Tesla positioned itself to collect from it. SpaceX's government contracts. SpaceX is marketed around Mars colonization and reusable rockets landing themselves like something out of science fiction. But a huge, steady chunk of SpaceX's actual revenue has come from unglamorous, recurring government and commercial contracts. NASA cargo resupply missions, satellite launch contracts for the Department of Defense, and Starlink internet service contracts. Predictable, recurring, contract-based revenue, the exact opposite of moonshot risk, even while the marketing is 100% moonshot. Real estate and infrastructure quietly built around his companies. Musk's ventures have also involved significant, less discussed investment in land, factories, the gigafactories, and infrastructure permitting, the unglamorous, capital-intensive groundwork that actually takes years of bureaucratic patience and boring paperwork, long before a single flashy product ships. So the pattern with Musk isn't boring instead of flashy. It's flashy on the surface, boring and structural underneath. The rockets and robots generate attention, valuation hype, and cultural relevance, which in turn makes it easier to raise capital and command premium stock valuations. But the actual dollars often flow through recurring contracts, subscriptions, and government relationships that look almost nothing like the marketing. Here's a relatable version. Imagine a gym that markets itself with flashy Instagram reels of intense workout classes, celebrity trainers, big transformation stories. That's the attention engine. But the actual money that keeps the lights on? Recurring monthly membership fees from thousands of regular people who show up or don't, and get billed automatically either way. The flash gets people in the door. The boring subscription is what pays the mortgage. Let's zoom out and talk about why this flashy on top, boring underneath strategy is so financially effective. There are 4 core reasons. 1. Attention is a marketing asset, not a revenue guarantee. Being famous, controversial, or culturally relevant creates enormous brand value and makes it easier to raise money, get media coverage, and command investor enthusiasm. But attention itself doesn't pay bills. The boring, recurring revenue businesses underneath are what convert that attention into durable cash flow. 2. Boring businesses are recession-resistant. When the economy tightens, people cut back on discretionary flash, vacations, luxury goods, new gadgets. They don't cut back on rent, utilities, waste collection, or essential government services. A diversified portfolio anchored in boring assets tends to weather downturns far better than one built entirely on hype-driven ventures. 3. Boring businesses have less competition. Nobody dreams of growing up to run a regional parking garage company or a permitting consultancy. That lack of glamour is precisely why there's less competition, fewer new entrants, and often better profit margins for whoever's already established in that space. 4. Boring businesses are valued on fundamentals, not sentiment. A flashy tech stock's valuation can swing wildly based on a single tweet, a single earnings call, or a shift in public mood. A toll road or a leasing portfolio gets valued on much steadier metrics: contracted cash flows, occupancy rates, long-term agreements. That steadiness is enormously valuable to anyone trying to protect wealth over decades, not just headlines over a news cycle. Put simply, hype is a great way to raise capital and get attention. Boredom is a great way to keep it. Now, in the interest of giving you the full picture and not just a tidy narrative, let's steelman the counterargument, because it matters. Counterpoint 1. Correlation isn't strategy. Critics of this framing point out that plenty of successful business empires, including parts of both Trump's and Musk's, also include genuinely risky, innovation-driven ventures that could have failed spectacularly and in some specific ventures did. Framing everything as a deliberate, boring money master plan risks giving too much credit to intentional strategy versus opportunism, luck, or simple diversification that any large business empire ends up with over time. Counterpoint 2. Access and scale aren't replicable. Some economists argue that these dynamics, winning large government contracts, negotiating favorable regulatory credit systems, securing prime licensing deals, depend heavily on existing wealth, political access, and scale that an everyday investor or small business owner simply doesn't have. In other words, boring businesses are great, is true, but you can replicate a billionaire's boring business advantage, is a much bigger claim and one worth being skeptical of. Counterpoint 3. Reasonable people disagree on the ethics. Whether it's appropriate for political figures or public personalities to benefit from government contracts, regulatory frameworks, or public attention in these ways is a genuinely contested political and ethical question. Supporters see it as smart, legal capitalism. Critics see it as an uncomfortable blending of public influence and private gain. This video isn't here to settle that debate for you. It's here to show you the financial mechanics so you can form your own view with better information. So to be clear, this video isn't claiming Trump and Musk are engaged in some secret scheme to fool the public in a deceptive, illegal sense. What we're really examining is a well-documented pattern in how large fortunes are built and protected. Flashy ventures for visibility and capital raising, boring ventures for durability, and asking what regular investors can learn from that structure. This is the part of the video where we bring it home for you, because none of this matters if it stays abstract. Look past the headline product. When you're evaluating any company, whether as an investor, an employee, or a customer, ask yourself, what's the flashy story and what's actually generating the recurring revenue underneath it? A company can have a boring core business wrapped in an exciting marketing story, and that's often a good sign, not a red flag. Recurring revenue beats one-time excitement. If you're starting a side business or evaluating an investment, ask, is this a one-time sale or does it create a recurring relationship? A local example, a mobile car detailing service that sells one-time details is exciting but unpredictable. The same business selling monthly maintenance subscriptions to fleet owners or property managers is far less exciting to describe at a dinner party, but dramatically more stable and valuable over time. Boring industries often have less competition. Think about unglamorous local businesses, laundromats, vending machine routes, self-storage facilities, HVAC repair companies, commercial cleaning contracts. These rarely trend on social media. That's exactly why they tend to have steadier margins. Fewer people are fighting to get in. Diversify between attention and anchor assets. Just like these business empires balance flashy, high-visibility ventures with boring, cash-generating ones, you can apply the same balance to your own portfolio or side income. Keep some exciting, higher-risk bets, growth stocks, a new business idea, a speculative investment, but anchor your financial foundation in steadier, more boring assets. Index funds, real estate, essential service businesses, dividend-paying companies. Takeaway 5. Don't confuse fame with financial health. Whether it's a billionaire or a local business owner, public attention and cultural relevance are not the same thing as a strong balance sheet. Learn to separate the story a business tells you from the numbers underneath it. That single habit will make you a sharper investor for the rest of your life. So, are Trump and Musk fooling Americans? That's ultimately a question about intent, and reasonable people land in very different places on it, depending on their politics and their view of these two men. But here's what isn't really up for debate. Both of these business empires demonstrate, in very real and well-documented ways, that the loudest, flashiest part of a fortune is rarely the part quietly doing the most work. The rockets get the headlines, the government contracts get the cash flow, the tower gets the name in lights, the lease agreement gets the check every month. That's not a trick reserved for billionaires. It's a principle available to anyone watching this video right now. If this broke down something you'd never thought about before, hit subscribe, because next time we're diving into the boring $40 billion industry hiding in your city's parking meters. Drop a comment. What's the most boring business in your town that you think is secretly printing money? I read every single one. This has been Z Invests. Stay smart, stay skeptical, and I'll see you in the next one.